Are we standing on the edge of a new era in commercial property investing? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. According to a recent article by the Retail Technology Innovation Hub, George Shaw, the fund manager of the Aberdeen Real Estate Fund, asserts that the landscape of commercial property investing has transformed permanently. Shaw, having managed the fund for 19 of its 20 years, describes the sector as being on the brink of a seismic shift. Reflecting on the past 2 decades, Shaw highlights the roller coaster journey of commercial real estate, marked by significant challenges such as the global financial crisis and the COVID-19 pandemic. The fund faced suspensions due to the Brexit referendum and the pandemic, emphasizing the sector's volatility. In the United Kingdom, potential regulatory changes by the Financial Conduct Authority, considering notice periods for funds heavily invested in illiquid assets, could further impact the market. Shaw believes this could alter how investors engage with commercial properties. To adapt, Shaw's fund is transitioning to a hybrid model, blending ownership of commercial stock with investments in real estate companies. This evolution aims to provide retail investors with the flexibility and choice akin to the residential sector, where quick transactions are becoming increasingly attractive. Shaw anticipates that this model will allow for more agile buying and selling of shares in real estate companies, improving access to targeted sectors. He notes a muted development pipeline for new commercial units, suggesting that demand may outpace supply in the short to medium term. Areas of focus for investment include data centers, student accommodation, and healthcare environments, which traditionally pose challenges for retail investor access without a managed fund. Shaw's insights reflect a strategic pivot in response to evolving market conditions. Despite global economic uncertainties, the commercial real estate market in Delhi-NCR has shown remarkable resilience, with a strong demand for office spaces, particularly in areas like Gurugram, Noida, and Faridabad. According to a report by Cushman & Wakefield, Delhi-NCR recorded a net absorption of 9.4 million square feet in 2024, with 2.9 million square feet absorbed in the fourth quarter alone. The first quarter of 2025 continued this momentum with significant deal closures and fresh leasing activity. The top 8 Indian cities saw a gross leasing volume of 20.3 million square feet in the first quarter of 2025, which is a 4.5% increase year-on-year, although it represents a 15% decline compared to the previous quarter's strong leasing activity. Delhi-NCR has established itself as a key office market hub, drawing multinational corporations and global capability centers due to its strategic location and world-class infrastructure. This demand has been particularly strong for Grade A office spaces, which offer superior amenities and sustainability certifications. In terms of sectoral drivers, expansion by global capability centers and multinational corporations in sectors like IT, IT-enabled services, banking, financial services, insurance, and startups has fueled growth. These sectors accounted for 56% of gross leasing activity across India in 2024. Infrastructure projects such as the Dwarka Expressway and Delhi-Mumbai Expressway are further enhancing the appeal of areas like Gurugram and Noida, making them attractive to investors looking for stabilized, income-generating assets. Private equity inflows remain steady, with investors viewing India's commercial real estate as a hedge against inflation and a valuable component of diversified Asia-Pacific portfolios. In downtown Hartford, a growing brokerage arm has taken on the mission of filling the city center's empty retail and office spaces. According to the Hartford Business Journal, NAI Lexington Commercial, led by President Kevin Kenny, is actively working to revitalize Hartford's downtown area after the pandemic left many spaces vacant. The firm was born out of necessity during the pandemic when Lexington Partners, the largest apartment landlord in downtown Hartford, saw a significant exodus of tenants from their mixed-use buildings. NAI Lexington Commercial's efforts have been instrumental in reversing this trend. They have managed to lease nearly 78% of the 157,020 square feet of retail space owned or controlled by Lexington in downtown Hartford. This is a significant improvement from the pandemic's peak, when almost 75% of their retail spaces were vacant. The brokerage, now an affiliate of the national network NAI Global, has expanded its reach beyond just the Lexington portfolio. As of January 2024, they've also taken on an additional 851,610 square feet of office and retail listings from other landlords in downtown Hartford. This expansion is part of a broader strategy to activate retail spaces and create a more vibrant downtown environment, which in turn supports the residential market. Kevin Kenny, who leads NAI Lexington Commercial, has been proactive in this mission, focusing on filling retail spaces to enhance the appeal of downtown Hartford. The firm has secured deals with notable tenants, including Insomnia Cookies, and is working on bringing in a grocery superstore to the area. The efforts of NAI Lexington Commercial have been praised by local officials and property owners for their tenacity and optimism. They recognize that a thriving retail and restaurant scene is crucial for attracting and retaining office and apartment tenants in downtown Hartford. This approach aligns with the city's vision for a revitalized downtown, making it a more attractive place to live, work, and play. The U.S. retail industry is no stranger to hard times. In recent memory, it's weathered the Great Recession, the pandemic, a surge in bankruptcies and store closings, skyrocketing inflation, and the black cloud of the war in Ukraine. Now, there's the threat of high tariffs and economic tumult, but landlords, real estate brokers, and retailers say they've been resilient and adaptive, dealing with headwinds before, and this year will be no different. Some told CoStar News they're not paralyzed by the challenges. They're still looking for tenants for their redeveloped malls or for the spaces left vacant by bankrupt retailers. Others are on the hunt for acquisitions or looking to shed properties. Investors with dry powder, skittish about office and multifamily properties, can turn to open-air shopping centers, which have performed well. Chains that promised Wall Street they're expanding must find store locations, even if retail space is tight, driving leasing activity. That's why about 25,000 people have made their way to Las Vegas this week, to do deals despite the choppy waters. The annual national ICSC Conference is the largest U.S. gathering for retail real estate. Some companies have hundreds of meetings scheduled for the show, which officially kicked off this weekend and ends Tuesday. Various brokers and landlords, including a number of real estate investment trusts, said they haven't yet experienced a slowdown or retailers putting the brakes on their plans to open more stores. But in Las Vegas, among their peers, some said they'll likely get a better sense of the mood of the industry. The challenges posed by the macroeconomy, new higher tariffs on imported goods, uncertainty about where interest rates are headed, and a possible recession, may prove to be a bigger threat to the retail industry than some expect. Strains are starting to show, with home goods seller Kirkland's recently reporting it may not be able to continue operating because it so heavily depends on imports from China, and some retailers have lowered their revenue and profit guidance for the year. ICSC attendees like Bryn Feller, managing director at Northmark's Chicago office, expect to get a good sense of the industry's outlook in Las Vegas because that's where the big players will be. Mall landlords such as Simon Property Group say the tenants they're finding to lease vacant Forever 21 stores are paying much higher rents. This is the fundamental conference where everyone who's truly active in the investment sale and the retail development business is going to be, said Feller, who handles investment sales. Meeting face-to-face with clients and tenants this week is crucial to the retail real estate business, according to Feller. Several executives attending the conference are optimistic. James Taylor, Chief Executive Officer of retail landlord Brixmor Property Group, said his company has over 500 meetings set for this year's gathering. Against the backdrop of tariff threats and concern about a potential slowdown in consumer spending. The nature of our asset class is pretty resilient, Taylor said, referring to open-air shopping centers. It's pretty defensive. It's cycle-tested, and I think retailers that want to do business recognize that. He's attended about 30 of the ICSC confabs during his career. Discussions at this one will be about the future, but not about 2025, according to Taylor. A lot of the business that we're going to be talking about at this conference is really for 26 and 27, he said. For most of us retail landlords, we're kind of done with the activity we expect to deliver in 25. So you have these retailers that are looking through potential near-term volatility, and making long-term commitments to physical stores that remain their most profitable channel of reaching the customer. Still, there's been concern that tariffs may lead to empty store shelves down the road, and one supplier has already warned of a possible shortage of toilet paper. But it hasn't come to that yet. In part, that's because some retailers stockpiled imported goods before the new fees went into effect. Other chains have reduced their dependence on merchandise from China. Walmart said Thursday it has been carefully managing its inventory to avoid problems, but the retail giant still expects to raise some prices to offset the tariffs. Last week, the chief executive officer of the nation's biggest mall owner said that except for one European retailer deciding not to take 4 outlet leases, there hasn't been a slowdown in activity. We haven't seen across the board by any stretch of imagination a reduction in leasing demand. It's business as usual, David Simon, head of Simon Property Group, said on a first-quarter earnings call. The supply is still very much constrained. Demand is still strong. In a note, Truist Securities wrote that Simon Property continued strong leasing demand/momentum for store openings, despite macro uncertainty, a theme repeated from most other retail real estate investment trusts. Matthew Harding, chief executive officer of New Jersey-based Levin Management, which oversees a portfolio of 16.5 million square feet of retail space at shopping centers, hasn't seen a slowdown in leasing either. I think economic uncertainty driven by tariffs and other things will be a headliner at the ICSC Conference, Harding said. However, in our day-to-day business of interacting with tenants and negotiating and signing leases, we have seen little to none in the way of tenants pulling back the reins as of yet. So deals that are underway are continuing. We have a good pipeline of pending leases and started out the year with some great executions of leases, lease signings, and also store openings. In some ways, retail landlords are in the driver's seat today. The industry has survived, but evolved, in the face of a one-time glut of retail space, e-commerce, changing consumer habits, and the impact of the pandemic. Outdated malls have been razed or are being redeveloped, retail construction is at a virtual standstill, and weaker chains have been weeded out. That leaves the U.S. retail vacancy rate at a low 4.2%, according to CoStar data, and has chains that want to expand competing for space, according to some landlords. Vacancies by bankrupt legacy retailers such as Forever 21 are freeing up space for landlords to lease at much higher rents to tenants who really drive traffic, which is actually a boon to owners, according to Harding and others. Simon Property has new tenants for 50 of the 100 Forever 21 vacancies it has, paying twice the rent, CEO Simon said. Los Angeles-based Pacific Retail Capital Partners is repositioning the mall it acquired in New Jersey, Bridgewater Commons. It is repositioning that property to improve its tenant roster, to be a middle-market alternative to the mall at Short Hills, which has become increasingly upscale and out of reach for the budgets of some shoppers, according to Steve Casella, Executive Vice President of Leasing at Pacific Retail. The Bridgewater Mall already has 19 new tenants lined up, such as fitness apparel seller Alo Yoga and the Brazilian steakhouse Fogo de Chão to open this year, he said. Now the company is looking for new tenants for 2026, according to Casella. Pacific Retail is in the process of refreshing the mall, home to a vacant Lord & Taylor anchor, and planning a more extensive redevelopment of it. Landlords in their sit-downs with current tenants at ICSC will try to determine if their needs and goals are being met, or if change is necessary. The retail real estate business isn't just about leasing, it's about companies and investors looking to acquire, sell properties, or spend to redevelop properties. Dallas-based Centennial last summer got an investment from Lincoln Property, which has given it the financial wherewithal to expand its portfolio and pursue acquisitions and mall redevelopments. Looking for purchases is part of what will keep Paul Kurzawa, Centennial's president, busy in Las Vegas. The partnership that we have with Lincoln now gives us access to a broader array of capital markets and capital partners, he said. And so that has already proved to be really quite beneficial to us in terms of our acquisition strategy and pipeline that we're working on. We are very much well-positioned and very much in an acquisition mindset that we started this year and will continue to do so. That includes looking at regional shopping centers that are primed for some new capital to come in with a re-merchandising strategy, perhaps with the densification opportunity, according to Kurzawa. We still see a lot of opportunities in that space, and will continue to pursue those opportunities across the United States for the rest of this year and beyond, he said. Centennial has over 200 meetings booked at the conference, according to Kurzawa, with about half of them on his schedule. There are several factors driving retail investment activity, according to Northmark's Feller. Currently, an estimated $26 billion of net leased retail properties are on the market, because of loans coming due, for example, compared with $9 billion 3.5 years ago, she said. In addition, a number of public REITs have capital and continue to raise funds, according to Feller. They have to put that capital out the door, she said. So all of these factors are drivers for things needing to happen, but connecting the dots of what needs to happen versus what will happen is complicated by the shroud of uncertainty in all these different areas. Pacific Retail, which is involved in several mall redevelopments beyond Bridgewater Commons, has recently sold as well as acquired retail properties. We do have another raft of transactions that we're working on now, 3 or 4, maybe 5 transactions that we're working on, but this whole volatility in the market has made it honestly more difficult, Oscar Pera, Pacific Retail's chief financial officer, said. And because it's hard to predict, and so although it's a bright spot and has been a bright spot and it's viewed as a bright spot, this volatility has not been helpful. So it's not for the faint of heart. Para said he believes retail real estate nowadays poses a better investment opportunity than a troubled sector, such as office. We think there's capital that needs to be invested or that wants to be invested, and this retail is probably a good spot for them to park that capital, he said. That said, some investors have been taking advantage of weakness in the office market to pick up office properties at steep discounts. Brixmor has about 30 redevelopments in progress, including one at Barn Plaza in Doylestown, Pennsylvania, according to Taylor. And Simon Property plans to kick off $500 million in projects this year, including redeveloping and adding residential space to the Bray Mall in Orange County, California. David Simon was asked if the REIT planned to cut back on its capital expenditures this year. So I think caution is the word of order, but that doesn't mean we won't buy something or that we won't continue to do our pipeline, he said. Let's turn our attention to an intriguing redevelopment proposal for a historic shopping mall in Massachusetts. According to Tom Benoit from the Metro West Daily News, the owners of Shoppers World in Framingham are looking to add a residential element to this retail center. With the state's push to boost housing supply, this proposed facelift aims to transform part of the 758,000 square foot complex by adding housing units and office space. Urban Edge Properties, based in New York, acquired Shoppers World in 2023 as part of a $309 million deal. Their plan, presented to the Framingham Planning Board, focuses on redeveloping the area around the Kohl's department store while leaving the adjacent Chick-fil-A restaurant untouched. The proposal includes transforming 103,000 square feet of retail space into 90,000 square feet of retail and 31,000 square feet of office space, along with the addition of 224 housing units. The redevelopment is expected to enhance the property's value, with a potential valuation of up to $150 million. Shoppers World, which opened in 1951 and is one of the nation's first suburban shopping malls, currently attracts over 7 million visitors annually. The plan has been well received by planning officials, who see it as a great opportunity for the city of Framingham. Joe Norton, vice chair of the planning board, expressed support for the project, but suggested a more comprehensive rezoning of the area. Sarkis Sarkisian, Framingham's director of planning and community development, highlighted the project's advantages, including its proximity to the expanding Framingham Logan Express and local companies like TJX Companies. Urban Edge's executive vice president and chief operating officer, Jeffrey Muallim, mentioned that the project's timing depends on control over the shopping center. However, they plan to return to the planning board with a site plan review in 12 months. This redevelopment aligns with a broader trend of transforming traditional retail spaces into mixed-use developments, providing a more sustainable and versatile use of real estate. It's a strategy that's gaining traction in various regions, offering insights into how commercial properties can adapt to changing market demands. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.